All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hello, welcome to Macro Corner, proudly presented by Blue Line Futures. This is episode 6. I'm your host, Paul Wankmuller. We do have an accompanying chart book that's available in the description of the podcast on bluelinefutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to info@bluelinefutures.com for a free trial. My guest this week, the one and only Giannis Mindall. Welcome to the show, Giannis.
Hey, Paul, thanks so much for having me back on the podcast. I think we got a ton of data to cover again this week, so let's get right into it.
Let's do it. A little bit of a refresh from last week. The title of our podcast this week is the China Divergence, but looking at top things to watch this week, which is on bluelinefutures.com, sent out every Sunday, goes into a little bit about the unrest in EM and the contagions that we're seeing. We spoke last week about Sri Lanka, and lo and behold, this week the presidential palace was stormed. There were protests in Albania, Georgia, Macedonia, and Bulgaria, and political turbulences in Ghana. And we spoke about how this can happen when you have the two most essential things for the world, and the developing world especially, energy and food, and how they accelerate as a result of external shocks. Going into the IMF and the World Bank, what we're going to talk about today is how China has joined that club as a lender and can offer, relief for some of these countries with regards to food, potentially energy, and funding. So let's get up to it here. We have two questions that we're going to answer. What allows China to ease while other central banks are tightening? And what are the implications for risk assets? Let's go, Giannis.
Yeah, so you had a pretty nice summary right there in terms of the situation that's currently going on in emerging market nations and how China will possibly play an increased role in the context of developing countries under stress, in the context of a lack of food and the lack of energy. So what's been the predominant theme in China has really been the development around China's real estate sector, the fact that the Chinese government has for decades subsidized state-owned enterprise, and that's ultimately allowed these companies to compete on an international basis and ultimately crowd out other companies internationally. So one of the predominant things that we're right now watching is that Moody's has said that they downgraded 91 high-yield Chinese property developers. We have seen S&P Global just in June downgrade Greenland for what they call a selective default. So there has been a lot of negativity around the Chinese economy and where it's ultimately headed. We also see that the IMF has downgraded its long-term GDP forecast. So while that has really been a trend for much longer, we now see that the IMF also has downgraded 2024 and in the out years, the GDP forecast for China. So surrounding that negativity, we need to ask ourselves, where's ultimately the country headed? And there's a really interesting thing going on right now, which is the Chinese central bank going the exact opposite direction as most of the Western central banks are going in.
And they have, just based on what you said with regards to Moody's and S&P, they judge every country on the same standard when they're downgrading or upgrading one's debt, I'm assuming.
Yeah, exactly. So, I mean, you have to be careful with how opaque or transparent every single country is. So there are, of course, differences, but the same standard is supposed to be applied. And what we are seeing now is that the boom in Chinese real estate, which has at the peak made up 28% of China's GDP, construction related to real estate itself. So that's made up 28%. That's far above of the nations and the level of the nation see in regards to real estate. So as that sector gets downgraded, as that sector sees more stress, that's ultimately going to impact the trajectory of the Chinese economy, and how that's going to shake out is ultimately the question here.
Sure. So let's dive into slide 3. We're going to start off here, and we've been speaking about this the past couple weeks as well, how M2 shows the health of a growing economy. And I do see here that M2 has been increasing, I believe, since around 2011 in China.
Yeah, I mean, it's been increasing since, I mean, that chart really doesn't go back that far. But the
Mhm.
most important dynamic that we're seeing is that the Chinese M2 year-on-year growth rate has picked up from a trough at 8% to right now 11.4%. As of the writing that we put out yesterday, it was at 11.1%. That's a May reading, and we actually just got the new data for June today, and it showed an increase to 11.4%. So M2
Oh,
is
nice.
really just a measure of how much liquidity does the central bank induce, and in opposite in a directly opposite direction to what we're seeing in the West. When the U.S. we have seen M2 peak at 27% year-on-year growth, and that's really come into the single digits, and China is going the exact opposite direction. And that is also the case with the policy rate. So while in the US, we refer to it as the federal funds rate, so that's an overnight lending rate that
Yep.
banks have. In China, we see the 1-year loan prime rate set in at 3.7%. So that's an all-time low for that rate. And that just shows how easy the PBOC is going on financial conditions. They're easing financial conditions while the Western economies ultimately tightening financial conditions, and that's why it's called the China Divergence.
Absolutely. Yeah, they ripped the Band-Aid off earlier than the Western world and developed countries. I think we spoke about that a couple podcasts ago.
Yeah, and I mean, one thing to note is also we keep seeing headlines. I think last night we got headlines that some cities in China are picking up COVID testing again. Then there were some fines on technology companies, but
Right.
it's all about the rate of change. It's all
Right.
about where we're headed, and relatively speaking to what we've seen in the past. I mean, just reiterating on those headlines, the fact that 350% of that China has a banking system 350% the size of GDP. I mean, these are all really valid concerns, but the
Mhm.
question is how much support will the government give, and how much longer can they give the economy support in the context of um, probably a multipolar world going forward.
Well, I think that could lead us into slide 4 and 5 and 6, and we'll go through each one individually. But as any smart economist or person that's been dealing with China has seen, these companies were able to flourish on the global stage due to the ability of the Chinese government to help them along and give them kind of a little bit of a push, and some people might say unfair advantage on the global stage, but they are a force to be reckoned with here. So let's go into slide 4, the Chinese business conditions, and what does that mean with regard to that real estate bubble?
Yeah. So as we saw that crackdown on technology companies, the crackdown on real estate developers, with
Mhm.
Evergrande being the most um, famous example in
Right.
the context of China real estate. That was a property developer that ultimately defaulted on its bonds, and one of the underlying premise that the Chinese real estate sector has had is investors had the perception that the government would always be there in case of a default, in case of stress, because the goal of the CCP was ultimately to urbanize as many people as possible. And one of the ways in which they did that was to basically backstop anyone who was contributing to that process of urbanization. So, and as that support has waned a little bit, and we shall see how all of this shakes out, but as that support has waned in the past, Chinese business conditions came down. Those business conditions are ultimately just a representation of the macroeconomic backdrop that business owners feel or have, and that has rivaled the initial COVID shock lows. So we're really at suppressed levels here, and one would assume as we go out of lockdowns, as we go into that fall meeting we spoke about last week, where Xi is expected to get reappointed, business conditions are expected to be a lot more favorable heading into the fall.
Okay, would you say that this is, and I might be naive here, would you say this is kind of a survey, like you said, for business owners, comparable to the consumer confidence index, where we kind of gauge the confidence of the consumer? Is this something similar where you can gauge the confidence of the businesses?
That's exactly the analog I had to think of when I was looking at this index. So yeah, it's extremely similar, except that it's within the context of business. I
Right.
mean, one of the things to consider within the scope of the Chinese economy is that they are yet to make that transition to becoming a consumer is service-based economy. So in the
Hmm.
US, it's much more critical to measure consumer sentiment because 70% of GDP is consumer based. Whereas in China, as a manufacturing hub, it's much more important to gauge what the businesses are thinking. But yeah, the analog is definitely spot on.
That is an excellent point. And, in our lifetime, we will see that shift. And that's great. That was great. That was a
Yeah,
good
and just to chime in on this point before we move on to the next slide,
one. Mhm.
one of the things to consider, so even as we see the IMF lower their GDP forecast, as we see China definitely demographically challenged, it is all a question of where are we going to end up, relatively speaking, to what we have been, say, the last 6 months to a year. So that last 6 months, that was an extremely challenging period. We saw copper demand contract by 10% as a result of all of these dynamics playing out. But it's if we can set in at an equilibrium point that's more favorable towards the demand side for commodities, that's ultimately a positive. So
Right.
despite those downgrades, despite that extreme stress we're currently seeing, it really comes down to where we settle in, where that new equilibrium is going to be.
Sounds good. We'll be watching for sure. Let's go to slide 5, the China industrial profits. And I believe that that's going to tie right into slide 4.
Yeah, exactly. So China industrial profits, exactly as you said, the Chinese economy has long prospered on the fact that these Chinese state-owned enterprises have received massive subsidies. I mean, this has basically been the argument for tariffs, for more protectionism across the globe, that there are certain entities that receive government support and as a result are much more competitive on an international stage. So even with that support, we need to acknowledge that we've seen a contraction on the profit side of these industrial enterprises in China. So this is just another way of showing that business conditions have been really unfavorable for Chinese business. And the fact that we have seen this at negative 6.5%, I think it is really just a show on where we have been. And the fact that we're also going to see more favorable base comparisons is really important. I mean, we look back, say, to last year, beginning of last year, we
Yeah.
had those industrial profits grow by 80+%. So
Yeah.
naturally, that base comparisons are going to be much less favorable if you comp against 80% growth. But as that line comes off, as the comparisons get less steep, that's ultimately going to favor the year-on-year comparisons.
Gotcha. And that, just for our listeners out there, that the China industrial profits, that includes other manufacturers other than things like steel or cars. It kind of groups them all together.
Yeah, I mean, this is ultimately an index put up at the National Bureau of Statistics in China.
Hmm.
So I don't have exact insights as to what the composition is, but what we can see, this is just an aggregate index, the same way that we would measure the health of the economy and the profits in there.
Great. Sounds good. Slide number 6, we have the China industrial activity and the high levels of steel stocks indicating weak activity in the recent past. Tell us a little bit about that.
Yes, so the steel stocks are really just another way of looking at the slow Chinese economy in the recent past, and we are also really challenging COVID highs. So a high in steel stocks means a slow economy, and vice versa.
Okay.
So the fact that we have seen these steel stock levels rival initial COVID shock highs is really just another way of pointing to the fact that real estate has slowed in China. It's all about where we're going to settle in. Then we also need to consider the fact that the ports have been closed
Yep.
and the fact that less steel could be exported. And then we have one dynamic playing out where we see China hoard commodities. I mean, we're seeing key grains like corn, rice, where China holds 60+% of the world reserves. So whether that's a strategic, it's probably not solely strategic, but there might be a component to that where China wants to first look at its own economy and the fact that they need a certain degree of steel stocks. But then also, this is, of course, a representation of the fact that the Chinese economy has been really slow and we're coming out of this really suppressed period right now.
It's interesting. You're speaking about that. I think you said 69% of the world's corn reserves, 60% of rice, and 51% of wheat. Now, looking as a global picture here, if you do have famine in places like Sri Lanka or Egypt or Ukraine or etc., and China comes to the rescue, that's going to give them some brownie points, for lack of a better word, on on the world stage to those countries.
That is exactly why this is so strategically important. I think I had a tweet a couple of months ago where I basically pointed to that fact and China hoarding these key commodities. And what I spoke about in Sunday's write up too was if we view currencies through the lens of calories, I mean, what we see play out these days is the euro make new lows. We're almost trading at parity against the dollar.
Yeah.
We see the Japanese yen make new lows against the dollar. I mean, this is combined with MMT and all that stuff. But if we view currencies through the lens of calories, then the hoarding of strategic assets, such as the grains, food at large, is extremely critical. And I think it's hard to overstate the importance those grains will have as we turn to countries like Sri Lanka, where we see the presidential palace being stormed and ultimately pandemonium in some of these nations.
Sure. I love that. The lens, the currency lens through calories. I like that. That's good. Yeah, I mean, even, going back to Yemen, I guess it's been 8 years already, but that situation started with famine. This is not a new thing. This has been going on for a while, even before that.
Yeah, and even so, when we turn to past revolutions in China, we saw that those were either triggered or vastly fueled by the fact that there was not enough food. I mean, when the population doesn't have enough of what they need to just survive, that's
Right.
going to be that's going to result in things like revolution. I mean, that's not rocket science. That's just
Right.
a basic human necessity type of thing where we turn to a lack of food, a lack of energy, and that's ultimately going to impact the way different countries step in. I mean, we mentioned that in the intro of this podcast, where you have the IMF, you have the World Bank, and then you have countries that ultimately have the leverage of owning enough commodities so they can come in with support and ultimately get something in exchange. I mean, it would be extremely naive to think that there won't be anything in exchange. I mean, this is ultimately a global chess game,
Sure.
and there are different strategies at play here.
And I do want to add to that, which, directly towards the growing of food, is clean water. I mean, that hasn't even begun to be spoken about yet, but that will be another topic in the future. I don't have a doubt about that.
And we're even seeing the rationing of water and food, not only in developing countries, but I think I saw some headlines that in the north of Italy, they're rationing water already. So we see that not only be an issue in EM, but also really a widespread phenomena.
Well, I personally think that people should have browner lawns just so they can keep the water to grow those beautiful grapes out in Italy and France for some nice wine.
Yeah, I mean,
It's okay.
it's going to be an interesting conjunction for sure.
Yeah. Let's move on to the China real estate climate. This is slide number 7. And we were talking earlier about how the large percentage of the GDP that it is. But in addition, the China construction represents 20% of the country's copper demand. And we have seen the price of copper over the past couple weeks just come off, has not been looking good at all. What do you think about that?
Yeah, so I mean, China real estate was, of course, one of the hardest hit sectors in the Chinese economy. We know that China real estate and construction related to real estate represents about what has represented about 28% of China's GDP as of 2016. So that number is extremely large. And then, as you said, 20% of the country's copper demand, and China is 52% of the world's copper demand. So that's ultimately a large chunk of the global copper demand. And with real estate being one of the hardest hit sectors, that's ultimately going to lead, or already has led, to a spillover into the price of copper. I mean, then we have to ask ourselves again where we're going, and we turn to things like easy monetary policy, favorable fiscal conditions, and how that's expected to support some of those pressures that we are still seeing. I mean, the fact that we are still seeing Fitch and the and Standard and Poor's downgrade some of these Chinese property developers does speak to the fact that there are still pressures in that sector. To what degree that monetary policy and fiscal support is ultimately going to backstop all of this is sort of an open question at this point.
Gotcha. Makes sense. Moving on to slide number 8, and we can include slide number 9 on that one. U.S. Strategic Petroleum Reserves, and this has been in the news going back to even 2008. As soon as you see the price of oil pop up a little bit, you hear the U.S. start to talk about releasing oil from the Strategic Petroleum Reserve, which in theory is supposed to bring prices down to aid the consumer. Now, I see here, this chart goes back to 1982, but if I'm wrong, I believe the SPR was created on July 21st, 1977. Approximately 412,000 barrels of Saudi Arabian light crude was delivered to the SPR. And this, of course, is after the oil crisis of the 70s. I guess this was one way that the U.S. Was going to stock up, just like China stocked up on food.
100%. So it was first fell in the year of 1977, as you said. And one of the key debates that we've had in the space of hydrocarbons has really been, should there be a strategic petroleum reserve release just because there has been underinvestment, or is it supposed to be a tool with which you can act when you really need it in say, a war or other critical conjunctions? So with the U.S. petroleum reserves being at levels that they last saw in 1985, there is a potential, if capital flow into the energy sector doesn't pick up, that we'll ultimately see this number drop much more, and that's ultimately going to support the oil market, because as is the thing with markets in general, you should buy protection when you can, not when you have to.
Absolutely.
And if we're going to see a scenario in which they have to refill petroleum reserves on the back of releasing them right now, then that's going to put a bid beneath energy markets. So that's ultimately a longer term issue that we're going to follow here.
I think just to go along with that as well, you could say that you should borrow money when you can, not when you have to, because then the onus is put on the other person.
Exactly. You're supposed to retain that optionality. And if you don't have any oil stocks left, then you will inevitably have to refill them. And when that's going to happen is going to be the key question. I mean, we have seen about 7 years to a decade of underinvestment in hydrocarbon supply, while the demand picture has improved. So yeah, it's going to be interesting.
I think it would be interesting too to overlay the demand of crude with the SPR, because it really wasn't added to in the 90s, and that's kind of when oil was cheap, when they could have really pumped that up. Am I wrong?
I think that it's ultimately, I mean, this is partially political, and one of the things with politics is that issues really come to the forefront when people get hurt the most.
Right.
So the fact that they're releasing them now is really a reaction function to inflation being one of the number one concerns amongst voters. So
Yep.
until it it becomes a center stage issue, they won't really do anything about the strategic petroleum reserves. And right now they're releasing them. When oil's cheap, they're not really refilling them, and that sort of creates this reflexive sort of environment where you could have is an area in which they have to refill once prices are much higher than possibly now. So it's going to be extremely interesting.
Now, I mean, I guess oil doesn't go bad, but these are unrefined barrels. So even after they've released them, they still have to refine these.
Yes, exactly. And that's also a logistical challenge. So it's
Yeah.
not that easy to just release them if you don't have the refining capacity.
Right. Right. That's interesting. We'll have to take a field trip to the SPR one day. We'll see if we can take a look around and see what it looks like. I think it'll be interesting.
For sure. Yeah, I'd be down for that.
Yeah. So here we go. Assessing consumer oil demand by the product. We have the European gasoline Brent oil spread and the RBOB WTI. The one on the left, again, traded out of the oil coming out of the Brent Sea. That one is traded on the ICE, and the RBOB WTI crude oil spread that is traded on the CME, formerly the NYMEX.
Yes. So the spread between gasoline and crude oil is just a way of sort of gauging consumer demand for crude oil because you're ultimately consuming gasoline, you're ultimately consuming heating oil, not the crude oil itself. So
Yep.
the fact that these spreads are at extremely elevated levels on a historical comparison speaks to the fact that first, refining capacity is extremely tight, and second, that product demand is extremely high. So the question is, when is there going to be a breaking point amongst consumers? How inelastic is crude oil? How inelastic is demand for these products? And that's ultimately going to be a way for us to see when a breaking point might be hitting. I mean, whether that breaking point is going to be half a year from now, a year from now, it's all going to depend on the price of crude oil itself as well. But it's ultimately a really good way of looking at oil products and how inelastic demand is.
That sounds good. Giannis, it's been an absolute pleasure once again. The China Divergence. This has been Macro Corner, proudly presented by Blue Line Futures. This was episode 6. My guest was Giannis Meindal. I am your host, Paul Wankmuller. Don't forget that the chart book is available in the description of the podcast on BlueLineFutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to info@BlueLineFutures.com for a free trial. Thank you so much for joining me today, Giannis. I'm very much looking forward to episode 7. I think this has been a great day.
Same here. I'm looking forward to next week, and it was a blast speaking to you today.
That's it. Have a great week, everybody. Talk to you next week.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.